Hey there, welcome to Sullivan Smart Sense. I'm your host, Heather Sullivan. Today we are going to talk about banking and interest rates. Of course, we saw, the collapse of SVB and Signature Banks and, of course, Credit Suisse. And I know that's making a lot of people nervous about the banking system. And, of course, we've been seeing interest rates being raised and raised and raised to try and fight inflation. It's making a lot of people uncomfortable. So I've got an expert today. We're going to talk about how all these things are kind of interconnected and affecting each other, what you need to understand, and how you can feel confident and comfortable about making sure your money is safe in the bank, and how to just move forward during these times. So please join me in welcoming. This is Robert Gilliland, and he is the managing director of Concenture Wealth Management here in Houston. Great to have you with us, Robert.
Well, thank you for having me. It's exciting.
Yeah, absolutely. Well, first, let's just talk a little bit about what we saw happen with SVB and Signature Banks, basically kind of have a meltdown,
Right.
and Credit Suisse. So can you talk a little bit about what happened there? What do we need to understand?
Yeah, and I think it's really, really important to understand that this is not like what happened in 2008 and 2009. In 2008 and 2009, what happened there is that banks had been making loans that they should not have been making, and they actually were basically almost kind of they were in the process of going out of business. What happened in and specifically with Silicon Valley Bank was because of the ease of access and the flow of money, it was very, very easy. A lot of people had a lot of extra capital. They focused in the venture capital Silicon Valley type of companies, and those people had a lot of cash. Yeah. So they were making those deposits in Silicon Valley Bank. Well, banks make money by bringing it in and then making loans and trying to, because interest rates were so low, they started investing it to try to get a little bit of return on those deposits that they had. So they made the decision to hold these in a classification called hold to maturity. And when you hold these long-term bonds in hold to maturity, you cannot put hedges against it. Well, what happened is that Silicon Valley had a lot of these that they couldn't loan against, a lot of these bonds that they couldn't loan against, and they needed to raise capital. And that caused what's called a run on the bank. Well, and what's really interesting about this one was that you ended up with social media having a big impact, where people went on social media and said, get all your money out of Silicon Valley Bank, and they had a run on the bank.
So boy, that makes a run even worse these days, right? That's even faster communication.
And the speed in which that information comes out, right? And the ease of accessing capital online on your phone just to go to move it is very, very quick and easy. And that caused, they lost some billions of dollars, or had billions of dollars of assets transfer out within a very short period of time. So they needed money, and so they basically had to pull their assets from hold to maturity and realize the losses, because you got to remember that as interest rates go up, the price of bonds goes down. So those bonds, they would be selling at a loss, and so they ended up with a loss. Luckily, banks and FDIC and the government stepped in to bail them out, and we can debate whether or not that made sense. But what that pretty much did was stop the run on these regional banks. And regional banks are really important, especially like right here in Houston. A lot of energy companies utilize regional banks for their financing. And so they did that. The thing that's interesting about Silicon Valley Bank is about 90%, actually 90+% of their deposits were above the FDIC limits. And if they would not have been, if those deposits would not have been guaranteed, there would be no reason for anyone to keep any money at regional or community banks. Everyone would have pulled it all, and it would have gone just to the big banks.
What is that limit now? Because they raised it in the last banking crisis, right?
Right. So the limit now is still $250,000.
Okay.
So now a couple could have his account and her account, which could each have $250,000. Okay. They could also own a business. So his account, her account, and a business or a joint account up to that limit. Okay. So you can actually, going through and doing it, you can actually, as long as the accounts are titled correctly, and there's different types of accounts, then you can get more than 250,000.
Okay, well let's talk more about this, because this is, I think, the thing that is making people nervous. We're seeing reports about people pulling their money out of the smaller banks, putting it in bigger banks because they're worried that they're not protected.
Right.
And I know that in like the SVB case, the FDIC said we'll even cover it beyond that, to make people feel good,
Right.
well,
Right.
and make people whole. So let's say you're lucky enough to have, more than that 250 limit. Do we need to be looking at spreading our money in different banks, or like what would you say to someone who's concerned about that limit?
So what I would do is I would talk to my bank. If I have in excess of $250,000, I would talk to my bank and ask them, how can I get more coverage? Okay. Because it may be doing different titled accounts, individual accounts, and then a joint account. Okay. It could be, if you have a business or a trust, it could be having those accounts funded. It may be that bank can partner with other banks to get you extra coverage.
Mm-hmm.
Okay. It also may make sense for you to have accounts at different banks and different institutions.
Okay. Good to know. So just today, Jamie Dimon with JP Morgan Chase came out and said the banking crisis is not over and that there will be repercussions for years to come. What do you think about that?
I would hate to ever say that he's wrong. So I'm not gonna go and do that. I do think that the crisis and what that exactly means can kind of be up for interpretation, right?
Yeah.
There's no question that we've already seen a tightening of credit.
Yeah.
Okay. So since we've already seen a tightening of credit, what does that mean for home buyers? What does that mean for small and medium-sized business owners? It means it's going to be more difficult for them to get these loans, and they're going to have to pay more because of where interest rates are. So that crisis may continue with credit being pretty tight. So their ease of getting capital may not be over with. But I do think that it does seem like this has calmed down. What you may see is some of these regional banks that are very important in real estate lending, commercial real estate lending, may not have the appetite to take on as many loans as what they have been, right? So you may see it more difficult to get credit inside of there. Will we see more defaults or banks going out of business? That's possible. But it's also important to understand that it's not rare that a bank goes out of business. We've had since the Great Recession, we have had banks that have gone out of business. And the vast majority of them are very, very orderly. Someone else comes in and assumes the assets, and investors don't lose. Most investors, or most savers, I should say, don't have in excess of their FDIC limits inside of their bank accounts. And if that's the case, if you don't have in excess of $250,000 inside of your bank account, you really have nothing to worry about.
Okay. Well, let's talk a little bit more about lending, because I've been hearing that things have been tightening up again. So are they going to get as tight as they were after the 2008 crisis, do you think? And what would be your advice to someone who does need to maybe get a mortgage, a home loan, or a personal loan, or a business loan?
Yeah. So if you're in need of going through to get loans, yes, things are tighter. The difference is that it's just going to cost you a lot more. Now, I also would point out that I really think that some of this tightness is really regional. What's kind of interesting about what's happening right now is you really see it happening on this coast or that coast or in certain sections. Right now, Texas seems to be in pretty good shape. Houston seems to be in pretty good shape. Yeah. So access to getting those loans is good. The thing that you have to do is you have to make sure that you're looking through your cash flow and make sure that you can actually afford that loan. Because interest rates now for a mortgage are 6.5%, 7%, right? Rates have shot up from what we were used to the prior 10 years. And so you just have to be prepared that the cost of borrowing is going to be much greater for you.
Yeah. So, and then my next question is: so we saw the Fed; they just recently did another uptick, but it was a much smaller uptick. And I've seen debate about whether people think there'll be another one with what's happened lately. So I
Right.
wanted to ask, what are your thoughts? Are we going to continue to see rates go up? You think there'll be a cooling off? And how do we move forward?
Uh, yeah, that's the old magic. Get out the crystal ball and find that, right. That's really the question. So I'll tell you what we're seeing. Okay, what we're seeing is that the Fed has a mandate to get inflation down to 2%. That's why they raised interest rates 5% so far, right? The thing that's really interesting to note, what the real question ends up being, is will we go into a recession? And 11 out of the last 13 times that the Fed's been on a rate hiking cycle, it's caused us to go into a recession. Now, will this be a time that the Fed has magically engineered a soft landing? Maybe. There are some signs that inflation is coming down. It's very, very difficult when you have inflation at the levels where they are. It's very, very difficult to pull it down all the way down to 2%. But they have another issue that they're dealing with, and that is the labor market. The reality is that we have more jobs than we do people looking for jobs. The Fed would almost like to see unemployment jump up to about 5%. And that's going to be difficult because there are fewer workers because we're getting older, right?
Yeah.
And so, excuse me. So the Fed has a challenge. So what the markets are saying now is that there's a really good chance that in May, they're going to raise rates again, probably about 0.25%. So when they meet in May, the expectation right now is that they'll raise. They'll probably end up doing what they always do, and that is go too far and have to reverse course. Our take is that they're going to probably go on pause, meaning that they won't raise rates after May, and then see what happens after that to see whether or not there's a need to lower rates or raise them, because this is really important. When the Fed makes a rate hike or a rate cut, it takes about 9 months for it to work through the system. So we're just now starting to get those coming through. So they're just now starting to have an impact. But inflation, we're all paying more, whether it's for eggs, bacon, or gasoline, we're all
Yeah.
paying more.
Mhm.
And we all know that it costs us more to live today than what it did a couple years ago. And so the Fed wants to get those rates down.
Yeah. Well, let's talk about debt, because I know a lot of people are really struggling with the fact that their credit card interest rates are, some of them they're over 20% at this point. And so, what would be just some general advice that you might have for someone in terms of dealing with it, managing it?
Yeah, I think that the real key is that to make sure that you understand where your rates are right here. You need to, and what we tell people is that where you want to start is on those highest interest rate loans, and you want to pile drive as much into those. Once that gets paid off, you want to start with the next highest rate. Ideally, being debt free is where you want to be. There are certain kinds of debt that are okay, like a house or something like that. But your credit card debt, you have to be aware, because you're now looking at 20-25% interest rates. These are large. That's a lot.
Yeah.
And so you need to get really, really focused on making more than the minimum payments on those high rate mortgages or credit cards or debts.
Yeah. And then, we saw a lot of people kind of hold off on buying a home, first because the housing market was crazy hot. And
Right.
now because we're seeing these higher rates, what would be your advice to someone, if they're kind of on the fence about it, how to just navigate this time period, and maybe how to best prepare if they are going to take that bite?
Sure. Yeah. I mean, in fact, we have this conversation a lot. People want to upgrade or downgrade a home, but don't want to pay too much for a house. We tell them all the time, be patient. In the interim, or in this period between now and the time you find your ideal house, right? Your dream house that you want to move into, start saving extra money. Get extra money so you can have a larger down payment, which will mean that you'll have a smaller mortgage. Manage that. Assume that. Go ahead and figure out what those payments will be and start saving the difference between what you're paying now and then. Make sure that it fits within your budget. Get those other bills taken care of. But I think that if you're patient, we may see a leveling and maybe even a bit of a decrease in home prices here in the Houston area that may give you a better entry point to get into those homes.
Yeah. And I always try and help people feel better too, that really like Houston home prices were lower than a lot of the major cities around the country.
Yes.
And so we don't like it, but it's not as bad as it could be, right?
Thank goodness.
Yeah. What would be some just good money moves in general that you would have someone consider for a period like this, where we're still seeing high inflation, we're seeing high, how can we kind of, try and be prepared for an emergency and be smart with our money?
Yeah, the thing that is important right here is making sure that you have an emergency fund. 3 to 6 months of savings makes a ton of sense. It gives you the ability to sleep well at night and not have to worry about things. Get your bills squared away. Do extra savings. Here's the thing, is that interest rates are high. On the good side, at least now you're being paid something for having cash. We've gone through a period of almost a decade where we were paid nothing for having money sit inside of a bank, right? And 3 and 6 month CDs may not be a bad idea to keep cash, to keep money safe. If you have job security, 3 to 6 months worth of living expenses is a great idea. Making sure that you're focused on those debts, those bills, pay down what you can. It's all about cash flow. If you're someone who's getting close to retirement or going to be retiring this year, it makes perfect sense to have a plan in place in how to create an income stream. If you are that young up-and-comer executive or business owner that is growing their business and where it is, cash flow becomes king, and make sure that you have plenty on the side to meet your obligations so you don't fall behind, and it gives you peace of mind.
Let me ask you about, because one thing that's come up, a lot of people ask about, and I don't know how much familiar you have with them, but the I bonds, the bonds that go up with inflation. I've heard different schools of thought. Can you just talk a little bit about like what those are? Can they be helpful? Should people be looking into something like that, or are we on the tail end of that? Like,
so these are bonds that are related to inflation and interest rates. And so what happens is that as those go up, you get paid more. Specifically inflation, you get paid more. You get paid the inflation rate plus to be invested in those. Those are really good. The challenge is that you have to do them direct, and you're limited into how much you can put into it. Then you have liquidity issues that are inside of there. So we have found that the limits with those end up being something that there are other alternatives that we can go through to do better. And those would include, even though we're giving some up on the short side while we're waiting for the markets to stabilize, if you will, or find a better entry point, utilizing a CD inside there. There's a chance that those I bonds probably are not going to be as lucrative as we look forward, with an economy slowing down and interest rates starting to come down, or inflation starting to come down, as what they once were.
Yeah. That's, I'm glad we got to talk about that, because I get those questions all the time. And I do think that people really need to kind of consider the pros and cons. Well, as we wrap up our conversation, let's come back to banking a little bit. And again, we're seeing people just kind of nervous. So what would you say people need to look for in a bank, if they're choosing a bank, to make sure that they can feel safe, that their money is going to be safe?
Well, you can simply go to their website and see if they have FDIC insurance, right? Because there are some banks, it's a very, very, very rare, that does not have FDIC insurance. So you can go and look at on their website, and it'll say, or a sign at the actual branch, they'll have a big sign that says FDIC insurance. So that's one thing that I would do. The other is just make sure your cash balances, and make sure if you're concerned that your bank may go out of business. Well, one, you may want to look for a different bank if you're concerned about that. But I would go in and have a conversation to make sure that you're getting the maximum amount of insurance that's on that. Like I said, it's rare that banks actually end up going out of business and FDIC has to come in, but it does happen. And so I would be doing that. I would make sure that I have enough cash in those, and make sure that you're comfortable with the institution that you're doing business with.
Yeah. And credit unions are insured too. It's a slightly different insurance, but they're insured too, right?
That's correct. In effect, at a high level, they have the same type of insurance as FDIC. It's just administered by the National Credit Union Administration, and they have a separate fund, which is backed by the full faith and credit of the U.S. government. So you have the same type of protections at credit unions.
Great. Well, this is Robert Gilliland for everyone who's been watching. He's the managing director with Concentra Wealth Management here in Houston. Thanks so much for sharing all of your knowledge with us. I really appreciate it, Robert. And I think you've probably helped to make people feel a lot more confident about what's been going on.
Great. I sure appreciate the opportunity. Thank you.
Absolutely. And thank you so much for being with us as well. We'll see you next time here on Sullivan Smart Sense. Just keep sending me those notes about any questions you have or topics that you'd like us to cover, and we will take it up. We'll see you next time. Bye-bye.